Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you this morning, and as always, if you have any investment or retirement questions or concerns, send an email to Brian Rezny at ReznyWealth.com. I'll answer those on the TV show. Make sure you become an informed investor. You know, one of the things I've done, managing money well over 30 years, is really educate you, the investor. The most important thing you can do for yourself to create financial security is make wise decisions. And how can you do that? By getting your questions answered properly. And that's what this show is all about. I'm going to talk a lot about interest rates today, inflation, all the rhetoric you've heard from Wall Street firms and banks the last 2 years about the recession that was going to happen 2 years ago, beginning of this year, the imminent market collapse, all these different things we're going to discuss today. But of course, your questions are vitally important. Get them answered. Send them to Brian Rezny at ReznyWealth.com. Go to ReznyWealth.com, by the way, our website. And as always, go and download our groundbreaking report. The 3 biggest risks you must avoid now for 2024. It's a perfect report for anybody who has $1 million portfolio and greater. If you're a larger investor, you're concerned maybe about the advice you're getting, maybe you're concerned about what you're hearing about recession, market collapse, interest rates, and inflation, and you want to know what to do and what not to do, download our free report at ReznyWealth.com. 3 biggest risks you must avoid now. Well, let's talk just a little bit about interest rates. That's been all the craze the last 18 months. The Fed substantially, in fact, the fastest in history, have raised interest rates. And right now, the 10-year Treasury, some are hovering around 5%. Mortgage rates are at 7.5%. But again, this is still substantially cheaper than rates were 15 or 20 years ago. So even though rates have come up, folks, you have to realize this. The Fed or not the Fed, but really the current administration caused all the inflation problems you're currently witnessing. But inflation is abating and it is coming down. What the Fed's job is to basically rein in that inflation. You do not want 9% inflation year after year. Obviously, everybody in the United States witnessed the inflation you had last year. And so what I want to explain to every investor is Fed policy does matter, and they can somewhat control that inflation narrative, but it's really the administrative that is currently in the White House that really dictates policy that created all the inflation to begin with. But the Fed is reining that back in, and that is a net positive. We see inflation running at about a 2% rate as we get into 2024, so we're headed in the right direction. I've talked about this many, many times. I do not see the Fed raising rates anymore, and in fact, if anything, I see them starting to reduce rates as we get into the end of this year and the beginning of 2024. The United States continues to be the investment of choice for Rezny Wealth Management. We spend a lot of money as a money manager on research. We spend a lot of time researching not only our economy, but other economies and investment opportunities. And as I've talked the last 3 or 4 years on my TV and my radio shows, the U.S. continues to be the place of choice. And, you know, I consistently, we bring on new clients at Rezny Wealth Management every month. And it's interesting when these new clients come in, they're predominantly coming from other so-called advisors, the Wall Street big firms or the small firms or banks or insurance companies. And one common element is prevalent in every one of those new relationships that hire us from these other firms. And they all kind of say the same thing. I had the set it and forget it portfolio. Our portfolio went down when things went down and didn't do as well on the way back up. I hear that repeatedly. The set it and forget it. Because I've talked about set it and forget it on my shows for a number of years. I talk about the mass dilution of your return possibilities by investing in overseas investments that are still just really almost subprime and just garbage to be invested in. But most of the new accounts that come to our firm still have these big helpings of international investments that have done virtually nothing in the last decade or more. So look at your portfolio. How's it really done? Do you still have that asset allocation, that set it and forget it portfolio? and you still have a big helping of international investments that have gone nowhere in 10 years, how long do you let that go on? How long do you own and hold losing investments in your portfolio? We continue to like the U.S. Now, there could be a point in time we make some shifts into some international places, but I don't see that happening this year, and I certainly don't see that happening in 2024. Maurice from Fort Myers, thank you for your show. Two issues that keep getting bombarded with: reverse mortgages and selling your life insurance. What do you think? To me, it seems like rip-off artists. Maurice, you're probably talking about a lot of the commercials on TV that talk about reverse mortgages and or selling your life insurance. I will tell you this, they're not rip-offs, but you do have to do proper research on the firm you're going to utilize if you're going to do a reverse mortgage. Reverse mortgages are actually quite helpful because remember, about 80% of the people in the U.S. really have no savings at all or very little. So when they retire, their biggest asset is their house, and they may have a bunch of equity. All the reverse mortgage does is allow you to tap that equity without having to pay it back until you sell a home or until your death. So we like reverse mortgages for that group of 80% that really hasn't saved and has no investment portfolio. Selling your life insurance policy, that's where you have to do even more research to find companies that are reputable and suitable. But yeah, you might have an insurance policy, you're 65, you don't need insurance anymore, let's say, but you still have this policy. Could you sell that? You're not going to get a lot of money, chances are for it, but you could technically sell that policy and recoup some of the cost structure you've had over the years. And it's not necessarily a ripoff. There are some decent programs out there, but again, do your own research. Donna in Naples. What's the best way to learn if you're new to stocks? The best way to learn, Donna, is watch the Rezny Wealth Management TV show every week and listen to my live radio show on Sunday mornings. Go to ReznyWealth.com, click on my TV radio show tab, and it has times and availabilities. I think ultimately investors, if you're going to try and invest yourself, be prepared, Donna, to spend 30 to 40 hours a week in detailed research about investments you're looking to buy and already own. Investing isn't just buying XYZ because you've heard of it. Investing is a lot of hardcore research daily. You have to spend a lot of money for quality research. Most of the research you're going to find online that's free is kind of really mediocre at best and usually biased also. So we do not use this free research. We actually spend a lot of money on real research when we're doing portfolio management. But again, getting started, keep listening to the show. You'll learn a ton. Jay in Florida. I was approached by a financial advisor that was trying to get me to put my money into some type of insurance instrument. The bug selling point, I guess it should be big selling point, was that I could take the money from my SEP account, which is a qualified plan, folks, and then borrow against it to pay the taxes on my conversion. Absolutely not. First off, I'm going to tell you this. Anybody that is pushing this program is a charlatan and a salesman. Do not do it. You never take a qualified plan, whether it's an IRA, a SEP, a 401k plan. You don't take that money and you don't go and buy an insurance policy with it. You cannot transfer that money into an insurance policy either, as that is a prohibited transaction by the IRS. Prohibited. So I'll tell you what it is. You have yourself a charlatan, a salesperson that's trying to line their pocket, selling you garbage that's going to ruin your retirement. What you're going to do is you're going to take money out of your IRA or SEP. Let's say, I'm just going to use a round number of $1 million. You're going to have to take that money out. You'll have to pay full tax on that $1 million. You'll be left with roughly $600,000 to then stick in an insurance policy that you don't need. Why would you do that? Why would you instantly give up 40% of your money to federal taxes that will never compound again to be sold an insurance policy from a charlatan? Do not do it. I see this scam, and it's a scam, come up 2 or 3 times a year. We'll get calls from my TV radio show, or people will come in our office to talk to us about hiring to manage their money, and they've been approached by these charlatans trying to do this to you, the unsuspecting investor. Do not do it. I'm going to take a quick break. Go to ReznyWealth.com. Click on that consultation tab, folks. We manage larger portfolios. Our client minimum to start at Rezny Wealth Management is $1 million and greater. If you have a larger portfolio, if you're realizing the advice you're getting is substandard, you're not happy with the returns or the client service and communication you're receiving, it's time you stepped up to real money management that Rezny Wealth Management provides. Real money management, real advice, 100% of the time. Go to ReznyWealth.com, click on that consultation tab, and make sure you download the 3 big risks report you must avoid for 2024. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program, and as always, send your investment questions to Brian Rezny at ReznyWealth.com. We love getting your questions. We love answering and making sure you get educated so you can stay away from making bad decisions. One of the things we're most proud of with our TV and radio shows is helping you, the investor, really make those wise choices, keeping you out of investments that you should have never been sold or potentially getting into or being offered to by a so-called advisor. Remember, the only kind of firm you should ever entrust with your money is a fee-only fiduciary money management firm. Anything else is sales. Wall Street, banks, and insurance companies, none of these firms, 0, are fee-only fiduciaries, and none of them are money management firms in a fee-only fiduciary capacity. Remember that. They're sales organizations that are trying to sell you what's good for them and unfortunately not best for you. Let's talk about non-U.S. investors and what they're doing. This is kind of an interesting stat, and this is something that, of course, we look at all the time. Investors outside the U.S., guess where they're investing? They're pulling money out of their own countries and they're investing in the U.S. equity markets in general. And why are we seeing more and more of that? It's kind of like a bullet point that I talked about earlier, which is invest your money in areas that are going to treat your money the best. Sure, you can go invest in Europe or Germany. They've been lousy investments for well over a decade. Or you could invest in areas that have true growth potential. Remember, if you're invested in the equity stock market, if a company doesn't have the ability to grow their revenues and grow their earnings, you have little chance to grow that stock price that you own. You need revenue and earnings growth in order to have the opportunity to push that price higher on that stock. If I look over outside the U.S., there are a lot of areas that are just littered with countries that are really socialist in nature, low growth opportunities or no growth opportunities, have more risk than the U.S. marketplace, and virtually have really less opportunity or no opportunity for return. So just make sure you think about that when you're looking at your current portfolio. One of the areas that's starting to look a little bit interesting, by the way, is the bond market. And I've talked about this the last couple years. When bonds and interest rates are trading at super low levels like we saw, let's say, 2 years ago, owning intermediate long-dated bonds doesn't make any sense. There's too much risk. But now that interest rates are, again, you have the 10-year around 5%, we firmly believe the Fed's done raising rates. We think there's an opportunity more that they will start reducing rates. This is when it starts to get interesting on the bond side, where our recommendation and our thought was the last year and a half, 2 years, stay short-term duration, floating rate type bonds so that you don't have the big risk of a downward value of your bonds. But now that rates are up, we want to start moving out on that duration curve, meaning look at 3, 5, 10-year type bonds is where we're starting to look. We haven't officially nibbled, but we are getting ready to make some minor adjustments in our bond allocation. So again, look for those opportunities, those turning points when the Fed starts reducing rates, because that's the time you may want to add intermediate to longer term dated bonds in the portfolio and shift out of floating rate type securities. Minnie from Florida. I'd like to build wealth for my 16-year-old. Should I buy an IUL, which is a universal life type policy? Minnie, no. Your son who's 16 does not need life insurance. There's one reason, let's say primarily, there's a couple, but let's say one. The reason you buy life insurance, Minnie, is to replace the income if a breadwinner dies. Minnie, let's say you're a single mother. You make $50,000 a year and you pass away. Your family is dependent on your income. You should have some life insurance, okay? Your son or your daughter who's 16 is not the breadwinner of the house. They're not providing that income. They don't need life insurance. The biggest way you can blow your money and do your child a disservice is buying them a life insurance policy thinking that's an investment. It's garbage. Because why would you pay for an insurance that for somebody who doesn't need insurance? Why not just take all of that money and have 100% working for your son or daughter in an investment account? That would be much wiser. Life insurance is only needed for most people to replace the income if a breadwinner passes away. Once you're retired, you've built your net worth and you're living off your portfolio or Social Security or pension. Again, another reason why when you're retired, you probably don't need life insurance because your income is not replaced with the things I mentioned earlier. Bobby in Florida, I enjoy listening to your Sunday show. Do you feel it's a good time to purchase XLE? XLE, folks, by the way, is an ETF exchange traded fund that actually owns oil stocks. Fair disclosure, Bobby, we currently own positions in XLE, and we have for some time. I would say as long as the current administration has a war on fossil fuels, and by the way, we're going to need oil and gas for the next 50 and 100 years. Folks, it's not going away. But the supply side will slowly evaporate. Demand will keep steady and realistically probably rise. The EV craze is not working at all. We're going to need oil and gas for a long, long time. So we do like the XLE. Our positions can change at any time, but make sure you do your research. Again, one of the reasons we bought oil stocks was after the current administration, the Biden administration, was elected, and they decided they were going to put a war on fossil fuels. Because what happened? Oil prices went up. So when the thesis changes, so if the current administration is out next year or the year after, whatever, and a new policy comes in that they want to be energy independent again, we may not own oil. So just kind of think about that. So it's jumping on these opportunities when they present themselves. Oil may be owned for a long time, or it may not. It depends really on policy of the current administration, and that may change at any time. Rick in Naples, you talk about set it and forget it asset allocation portfolios. That's what I feel I have with our current firm. We see the downs, but never really see the returns. How to change it up is what I want to know. Rick, great question. So I will say this, the vast majority of advisors are really selling asset allocation programs through their big Wall Street firms, banks, or insurance companies. And generally speaking, it's more of a set it and forget it. All it means is they diversify your portfolio in kind of this pie-shaped breakup of different assets. And you own pretty much all these different assets all the time. There's really not a time where maybe they shift, like I talked about oil here, hey, oil's an opportunity, let's have a little bit more assets in oil. They don't usually do that in asset allocation. You always have this asset allocation pie, and at best, once a quarter, they rebalance it. So you own stuff you shouldn't own in that big pie that's over-diversified. You own things that maybe you should own. The problem is the stuff that's good gets diluted on returns with the stuff that's not so good. And when things go down, everything kind of goes down. But when things go back up, you don't do as well as you stated because you own a lot of things you shouldn't own. That's asset allocation. We see that a lot. The majority of our clients come from the big firms, small firms, banks, and insurance companies. And it's pretty much the same story. The stock asset allocation pie, rebalance, set it and forget it. And most people are realizing that's just not effective for their portfolio. They're still seeing risk, but they're not seeing the return opportunity. One of the things I want to stress to every investor, if you're at all concerned about the advice you're getting, go to Rezny Wealth Management. If you have a larger portfolio of $1 million and greater, and you'd like to talk to my firm about professionally and properly managing your portfolio, go to ReznyWealthManagement.com. Click on that consultation tab. And as always, download our groundbreaking report, the 3 biggest risks you must avoid now for 2024. It's at ReznyWealth.com. Click on the special reports tab. I'm going to take a quick break. I'll be right back with more questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I really hope you're enjoying today's program. As always, send your questions to Brian Rezny at ReznyWealth.com. Let's talk a little bit about this whole inflation. Really, is there a setback in inflation? Is it going back up? Is it still going back down? This is how we view inflation, folks. We're clearly, the bad part of inflation is clearly behind us. The rapid rise of interest rates by the Fed has really curtailed demand and is slowing the economy down nicely, so we're not rampantly buying just crazy and jacking up prices. So inflation is on its way down. But remember, that's inflation for this year, inflation for next year. Let me explain. If let's say you bought a loaf of bread last year for $1. And inflation last year was 9%. So this year, let's say at the end of the year, you had 9% inflation, and now that loaf of bread's, $1.09. The next year, if inflation starts dropping back down to the 2% level, it doesn't mean that your loaf of bread's going back to $1. That inflation is probably embedded in the cost of that loaf of bread or that, dozen eggs or the milk or whatever it is that you might be buying. What you don't want to see is 9% again this year and 9% again next year. That creates a real problem for all consumers. But we're headed towards that 2% target, which looks good, and we're optimistic for that. So again, we feel the Fed's done raising rates. These are when you want to start looking at making those strategic adjustments to your overall portfolio, looking at the other side of the tunnel and the opportunities we probably will have for another bull market the next 3 to 5 years. Phil in Fort Myers, Florida. Lucid stock. Is the market sell-off an overreaction? Phil, Lucid is basically an electric vehicle maker of cars. The company's not making any money. It's losing a lot of money. Most car companies are just lousy investments. Tesla's doing actually quite well and they're profitable. Valuation is very high. But general car companies like Lucid, Ford, I can go on, really have been lousy investments long term. As an investor, I would stay away from the car companies completely. Tesla might be the exception. And the reason for that is capital outlays, low profit opportunity, recessions just kill these companies, massive debt across the board. There's so many other better opportunity places I feel you can invest your money. Car companies are certainly not it, and Lucid certainly is not, in our opinion, a good investment. Bill in Florida, are penny stocks a good investment? No, they are not. Generally speaking, don't even waste your time, Bill, buying any stock that doesn't have at least a $5 share price value. And why is that? No big money manager or institution is going to look at stocks under $5. That's number one. No analysts are going to basically look at those stocks under $5. That's number two. When you start buying penny stocks, you're buying thinly traded stocks that have big bid and ask spreads when you buy and sell them. People think, well, I found this stock for 30 cents, and I read this report on it. It's probably a biased report. I will tell you, people lose a fortune in penny stocks. Look at the movie Wolf of Wall Street. That was all about penny stocks. Stay away from crummy garbage stocks. Look for quality companies that are growing earnings and revenues that are trading over $5. Do a lot of research. You'll be glad you did. Bernard in Naples. Air Products is the hydrogen revolution. What are your thoughts? Hydrogen is probably going to come around in some form or fashion for motor vehicles, I see that as an opportunity. There's a few other things that are actually coming up too. Is Air Products a great investment because it's going to get all hyped up? I would say not. So don't bet on it for the hydrogen prospect for a revolution of the auto industry. I think that's the wrong way to look at it. I think often investors say, hey, should I buy this stock? I'll give you a great example. Should I buy, as an example, Pfizer stock during COVID because they came up with a vaccine? No. Because everybody knew Pfizer was coming up with a vaccine. It was already priced into the stock. And then what happens when COVID dissipated, obviously what happens, people aren't getting as many shots, so the profit from that vaccine is basically done. And all of a sudden these stocks basically come down quite a bit. So if you're jumping on something because there's this new headline of they just developed this or just did that, chances are it's already reflected in the stock price, and that usually is often more of a reason to sell than to buy. I think a lot of investors chase headlines. You need to look at research, and you'll need to look at companies that are fairly valued but have opportunity for upside on revenue and earnings growth. Leo and Cape Coral. Undervalued gold investments for a shrinking dollar. Leo, we currently do not own gold. We have no plans in the immediate future to buy gold. Gold actually year to date is up like 1% year to date. The equity market's up like 13-14%. Gold is not a great inflation hedge. Actually, oil is a better inflation hedge. I think really looking at gold as an investment, people buy gold because they fall into that fear factor and they become emotional. They look at these commercials on TV. Buy gold now, or you get emails about the demise of the dollar or the currency not going to be the currency of choice. I will say this, that is not a reason to buy gold. Gold has not been a great investment long term. There's been other investments that have been better. There may be times to own some gold, but not that the world's coming to an end reason at all. I hope that answers your question. Folks, you guys are inundated every single day in your email inbox with TV commercials that are trying to sell you something. Gold is one of those. Gold coins, Bitcoin. Don't buy garbage investments. At the end of the day, buy quality investments that make sense, again, that have earnings and revenue growth potential. Diversify the portfolio properly, but don't over-diversify. Don't overload the boat in any one investment, because that's a lot of risk. Never set it and forget it asset allocation. Stay out of the international markets right now. There's better opportunities, we believe, in the U.S. Those are important points that you need to think about. As always, if you're looking for real money management and you're not happy with the way your money is currently being managed, maybe you have lackluster returns. If you're looking for honesty, integrity, compassion, and competence, that's the difference we provide our clients. If your portfolio is $1 million and greater, and you'd like to talk to my firm about professionally and properly managing your money, call our office during the week to schedule a consultation, or go to ReznyWealth.com and click on that consultation tab. We'd love to help get your portfolio back on track. Again, we do manage larger portfolios of $1 million and greater. Make sure you go to ReznyWealth.com and make sure you download our 3 biggest risks report you must avoid now. We'll see you next week.